training program. And what we're going to talk about today is when you bought the dip and the market dips off with your money, what do you do now? And this is going to be a really, really good video for people that first want to understand how to profit off the downside of the market. Two, they want to understand how come they're being compelled and encouraged to buy into companies as they're starting to slide down and lose value. Why is there such a massive campaign through mass media, through a lot of social media influencers, through a lot of media personalities to continue to communicate to retail that as companies are selling off, that they as retail should buy more? Why is this taking place? Three, the person that wants to kind of understand how to navigate this situation properly and become a much more savvy, active participant in the market. Because what we want to do is make sure that you get into the market, but we don't want to feed you to the lions and we don't want to feed you to the wolves. And if you're starting to feel like that is what is going on because you've seen over the past 1 to 2 weeks, your particular portfolio start to lose a lot of value. If you want to prevent against that happening in the future, you need to continue to stay tapped into people like myself that's going to make sure that you get the proper understanding. Make sure you get laced with game properly about this market. Okay. And we're not just running a big hype operation. So let's get into it. So when we're looking at the NASDAQ, it was seen over probably the past 5 days, but really from 3-1 to 3-5, what you've seen is a massive sell-off. And really this market has been selling off pretty much over the past, let's say, week and a half, maybe 2 weeks. It started really last week. It's continuing to this week. We had a really good green day on Monday. And then, that really was a pump fake. And then they started selling the market off again. A lot of people says it has to do with treasury yields, and that's 100% correct. OK, so we understand that people are always looking to get an acceptable rate of return on their capital. And one of the reasons why so many people ran into the market post-COVID is because at that particular time, that seemed like the best place to get an acceptable rate of return on their capital, especially in the tech sector, because a lot of people believed that a lot of these tech companies and a lot of these tech applications that have been created were either going to be unaffected by COVID or were going to be able to benefit from COVID. You understand me? But what we're seeing is something that people were speaking about late in the fall is what we call a rotation out of tech. So during the COVID situation, tech was really supporting the whole market. If you look at the S&P 500, but not just the NASDAQ, but also the S&P, you'll find that many of the companies in the S&P that have the highest amount of weight are tech companies. Therefore, tech was really supporting a large amount of the market during COVID. And what we're seeing now is that many of those same companies that were supporting money's flowing out of those companies. Now, not all of them, but many of them, and especially a lot of the very speculative companies that maybe didn't necessarily have the amount of weight, but there's so many of them. We're seeing a massive sell-off in the NASDAQ that's also flowing into the S&P 500. I want you to understand that. Now, the reason why this happened is because of people were leaving other areas to invest in and putting that money into stocks, but also into a lot of tech stocks that they thought would provide a safe haven for them in this particular COVID environment where people didn't really understand what were going to be the new rules of engagement around how we were going to have to operate in business from a socialization standpoint and things of that nature. What we're seeing is that government regulation, ordinances, things of that nature are going to get us back to what happened before this whole COVID situation took place. And essentially a year from COVID really slamming this economy, there's been a big push to get everything to go back to normal. You understand me? So what we've seen is that people are starting to look now for other places to put their money into, which is causing people to become aware of that. And we're starting to see money flow out of the market into other areas. And I mean market, I mean like equities. So we're seeing money flow into other areas. So it's not just treasury yields. It's really a desire to get a lot of money out of the stock market and to put money into other areas because really, really big funds, really, really big investors. One thing that they are really passionate about is diversification. They don't like to be really concentrated in one area. So they were just waiting for this to happen so they could go ahead and make the move that they always wanted to make. Now, what they're doing to retail is there's been a massive misinformation and disinformation campaign that is going on to compel retail to support a lot of these companies with bad fundamentals, a lot of these speculative companies with their money. So the institutions that are still currently in these particular companies can trade places with them and they can move out. This has been going on a very long time. And I'm going to show you examples of this. And I want you to really understand is that people that are on television, first, radio, social media influencers, that are compelling you to buy the dip. Sounds real good. It's a really catchy tagline, buy the dip, right? It's catchy to tell people that, you know, when the market tanks, stocks are on discount, the market is on sale. Sounds real good. I mean, you know, the human brain is really, it really takes the platitudes and colloquialisms really well, which is why so many people use them. So a lot of times when you want to take a really, really complex issue, you boil it down to very, very simplistic terms, because then it allows you to scale it out to the massive amount of people. But the issue is that a lot of people don't really understand what's really going on. They just know the colloquialism of the term. So a lot of people say buy the dip without understanding that, well, why did it dip? Without understanding that, well, maybe it's dipped because I don't need to be in there. So just because a company is selling off doesn't mean that you should buy it. Okay, but if all you know is buy the dip, then you have this Pavlovian response to buying the dip, which is I should buy it because the Pavlovian conditioning is buy the dip. So you got to kind of understand how you've been conditioned by a lot of these forces. And I told you before, many of these people that have been indoctrinated into this particular system are not here to make sure that the information and the education that you're getting is right and exact. They have taken an oath to this particular system to engage in the misinformation and the disinformation of the masses, or like some people like to call it 85%. But let's keep getting it to it. What I want to do is I want to show you this article from a guy named Ron Barron. Now, Ron Barron was one of the people that came on TV multiple times over the past year and said that he believed that Tesla should be around $2,000. Now, the guy's a billionaire. He's got a lot of money, runs a massive fund, right? And he talked about that as of February 28th, his particular Barron Capital sold 6.1 million Tesla shares. Now, he said that the reason why we sold these shares was because of what? Risk mitigation. Now, one of the things we always talk about, the highest paid part-time job in the world, is the number one thing you got to do is manage risk. Sorry about that. Says you got to manage risk. Well, why do you got to manage risk? Because the game is about not losing your money. If you really focus on not losing your money first, you can always find an opportunity to make money, but you don't want to lose all your money trying to make money. So you always want to be involved in risk mitigation or risk management. That is always the most important thing you need to be doing as a manager of capital. So he understands that it's his fiduciary responsibility to take his clients' money out of Tesla, okay? Because that's what they need to be doing at this particular time as risk mitigation. Now, 6.1 million shares, they purchased at an average cost of $42.34 a share. What is Tesla right now? So they caked off. Now, most of y'all that's in Tesla right now currently that bought over the past year, you didn't get in at $42 a share. You didn't get in at $42 a share before the split. You definitely didn't get in after the split. So he has a bunch of people working in his firm, not working in his firm, that were part of his particular fund or firm that on an average cost of $42.34 a share, and they now exited out of Tesla from a risk mitigation standpoint. Why? Because they see the writing on the wall. And they were sold over the last 6 months. So while he's on, so 1.2 million of those shares were sold at $400 to $900 a share, but they bought in at $42.34 a share. So now while this guy's on television telling you that he believes Tesla's going to 2,000, he's telling his internal clients, right, the people that he has a responsibility to, that he's accountable to, he's telling them, well, you know, I think we should get out of Tesla. I think it's a good time to exit. Why? Because it's had its run. But he's also taken an oath to this system to continue to do what? Misinform, create disinformation campaigns, create misinformation campaigns to retail. And this is not a big conspiracy theory. Once you understand what's going on, you will see these type of communication patterns going on all the time. Okay? Because we talked about before, they really believe that this space is a space that only should be for the elites. So they don't want regular people in this space. And if you do get in here, they're going to take a certain amount of what they do and a certain amount of their resources, and they're going to use that to try to confuse you as to what is actually going on. Now, we're going to talk about somebody that's talked about really heavily on the internet. That's Miss Cathie Wood. Now, her ARK Invest ETF, right, that everybody's so bullish on, has lost all of its 2021 gains. Okay. Now, what we're saying in 2020, the ETF skyrocketed around 150%. Had a massive return. One of the reasons why is because it was being anchored by Tesla. So we see that the ETF's largest holding was Tesla, right? Had around 10%. So let me see, can I highlight that? Had around 10% of this particular fund. Okay. And that is currently down 29%. So because she anchored her fund with Tesla, once Tesla goes down, her fund goes down. But because she anchored her fund with Tesla, This is why she's so bullish on Tesla. And she did an interview the other day, I think it might have been yesterday, on Benzinga, where she talked about she's going to come out with a new price target for Tesla because of their automation and yada, yada, yada. Well, she has to be bullish on it because she has a fund that's being anchored by this particular company. So she has to continue to convince people that Tesla's the best thing since sliced bread. And what's interesting about Cathie Wood is that she's not the only fund manager in the world. There's literally thousands of them. But for some reason, she's the one that they always bring on television, or they always put her on some type of internet platform, and they get her to talk about her holdings and why she feels like this particular company is doing well, this, that, and the third. And she's also one of the people that over the past 2 to 3 days has been buying Zoom while it's going down. And she also talked about, well, I believe Zoom is at a discount. We're going to go into that later. Right? So this is part of the misinformation campaign. Now you have a guy like Michael Burry. Now there's a reason why they don't let this guy on television. He has a Twitter account. His Twitter account is up. He takes it down. He takes it up. He takes it down. Because he is not going to repeat the company line. So he came out and said that he believed that Tesla could fall 90%. Right? And he also tweeted that to Musk. Now, Musk on Twitter, he's a internet gangster where he's very, hardcore on Twitter. He talks to people like he's stupid, yada, yada, yada. He's attacked several women on Twitter. But what we notice is that when Burry added him on Twitter, he didn't have anything to say because he understands who he can deal with and who he can't deal with because he knows who this guy is. You understand me? Now, they don't let Burry get a lot of interviews, and they won't let Burry get on television and talk about, why he's bearish on Tesla, his analysis, his narrative, or why he feels like Tesla is overvalued. Because the narrative has to be that, or over the past year, is that Tesla's the best thing since sliced bread. They're going to have flying cars. They're going to have cars that you're going to get in and you're going to be able to go to Mars, yada, 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 because that's where all the big money was at. So we got to keep this thing propped up until we decide to leave. And as we saw with Ron Barron, they leave and you don't find out till they're out of their position. Then you get hip to the fact that they've left the position. But you only know about the last story where the guy told you that he believed Tesla's going to be $2,000 a share, even though he told his own internal clients from a risk mitigation standpoint, it's time for us to exit out of this company. You understand me? People like this don't get the attention, even though they have a track record of massive success in the market. But they don't get the hype because, one, they're not going to repeat the company line. And because they're not going to repeat the company line, they don't get on the platforms. They don't get the attention. Nobody makes a million YouTube videos about them because they're not telling people what they want to hear. And when he told people in 08, or really before 08, that the housing market was going to fall because it wasn't what the people wanted to hear, they didn't listen to him because everybody was making so much money during that particular time period. But he was 100% correct. And he waited 2 years for it to fall. And everybody, including himself and the members of his fund, they cashed out real big. But it took 2 years for it to happen. He was very early on it, but he saw it a mile away. You understand me? So this is what I want you to understand, is that a lot of people that are going to get you to participate in buying the dip, either one, they don't know what they're talking about. Two, they have been assigned to misinform you or disinform you. Or three, the only way they know how to get attention is to just repeat the company line. Now let's get into some of these charts because I want you to show you what I'm talking about from a chart standpoint. This is Zoom. Okay. So we understand. Let's go to the 2 year. Zoom for around 2 years was under $100. Under $100. Right. Then started to walk its way up. Now we're seeing around March 2020 is where we start to see the big movement up on Zoom. Okay. Now we see this massive gap up. So Zoom closed at 325, and I believe this is right after earnings. Closed at 325. The next day it opened up at 439, a massive gap up. Sold off. Now I want you to understand what we're seeing with this chart. Okay, now some people ask me, can we put lines? I don't think a line is appropriate in this particular situation, so we're not going to put a line here. But what I want you to understand is that on 9/1/2020, when Zoom opened with this massive green bar, what did you see the next few days? You saw selling. Why do you see selling? Because people understood that this company is overvalued. It's overvalued based on the business model, based on the fact that they don't have a moat, based on the fact that their technology is going to be easy to copy. We don't really understand their attrition rate They don't have plans of how they're going to increase their average order value, how they're going to increase the lifetime value. Zoom blew up because of a situation where the situation was not going to last forever. So when the situation is over, what is the value of Zoom? So what you see after this massive day, you see a lot of selling. See a lot of selling. Who came in here? The buy the dip crowd. The people that talk about it's on sale. The people that talk about we got it at a discount. And what do? They bought in, sold some more because people got out of position some more. Then what do we see? Massive buying. And they bought this thing up to around 500. Consolidated a little bit, but kind of almost dipped. Then people bought into it even more. Around 568. Now, at this 568 close, which is on 10/19/2020, what have we seen Zoom do since then? It's been selling off. It's been selling off. Now, people bought in at 568. It's been selling off. People bought in around the 530s, been selling off. People bought in around the low fives, consolidated a little bit, started selling off to get out of the fives and went into the mid to low fours. This is what we're seeing. I want you to understand that. Now, here's the buy the dip crowd. They come back, buy the dip, massive sell off. Consolidates, right? Here comes the buy the dip crowd again. They buy back up, massive sell off. Sells off again, consolidates, buy the dip crowd, sells off again. You've been seeing the same pattern with Zoom, right? Going on literally since 10/19/2020. Every time the buy the dip crowd shows up, it sells off again. Because all people are doing is waiting for the buy the dip crowd to show up. And then people justify that by saying, well, hey, I got documentation that show that Kathy Wood bought this many shares of Zoom. So that means I should buy too. Knock yourself out. That's all they're waiting on. Because you don't understand why she's buying as compared to why you're buying. And you don't know her time horizon. How long is she going to hold that particular position? Right? How much capital? As a fund manager, she has to buy something. Right? They don't really give you a fund to manage for you to take everything and to move into cash. They want you in the market trying to get a return. Because the people that are giving you the money, if they wanted to hold their money in cash, they will hold their own money. They're not going to give you the money and let you get a certain percentage of the fund as a retainer for managing the fund, and you just going to put everything in cash. So she has to put the money somewhere. However, you're not obligated to that. So you could take your $100,000 and say, you know what? I don't like the way the market's looking right now. Let me pull my money out and let me just put my money in cash until this thing settles down. Because you got to understand, as a trader and as an investor, cash is a position. When you're mirroring the trades of somebody that has been assigned to preside over capital, and they get paid based on the pool of capital that they're presiding over, it doesn't look good when that person says, you know what, we're going to pull everything out and put it in the cash because we don't like how the market is looking. They got to trade because they're only there to get a return on the capital. If they don't get a return on the capital, you don't need them. You don't need them to put your money in cash. You're giving them the money so they can try to get a return. Therefore, their justification or their rationalization behind their movements can be totally different than yours. But like I said, the buy the dip crowd kept coming in and saving this company. Now, what do we see over the past 2 to 3 days? Right? So here's a dump. It's dumping down. People bought into it because it's getting ready to approach earnings. It's Zoom. Everybody's using Zoom because everybody's working from home because of COVID. Zoom killed earnings. Their guidance was outstanding for the first quarter of this year. What did Zoom do that whole day, which was Tuesday? Sold off. What did Zoom do the next day, which was Wednesday? Sold off. What did Zoom do today? It finished green by less than 1%. It was a green day by less than 1%, right? We're going to see what it does tomorrow. Now, I want you to understand this, and somebody told me to put lines up so they can really understand it. So let me try to do this. Let me see, can I get this correct? Because I don't really do lines like this. I just do the cursor. I want to show you where the support is at. That's a support. That's a support. So here's my basic support line. Okay, let me get rid of that because I don't like how that looks. Let me try it one more time. Their support is around 343. Okay. If this thing gets into the it gets into the low threes or gets under $300, their next support is around 260. So here's their next support in my mind. This is their next support. It's around the 260s. You understand me? Now, what you're probably going to get on this is what we call a dead cat bounce. So that's trader jargon, what we call a dead cat bounce. What we mean is that when the stock is falling, people will come in and buy it. You'll get a slight uptick or a slight increase in the share price, and then it'll dump again. We call it a dead cat bounce. You may see a dead cat bounce in here, but this is really where their support is. There's really no support once you get under this 300, because what do we see here? You saw a gap up and all the support was around here. All the support was here. So if this continues to sell off, there's nothing stopping this thing from free falling. Now, while this is free falling, you're going to hear a lot of people tell you to buy the dip and Cathie Wood bought in and yada, yada, yada. Because like I said, there's 3 reasons, and you can hear them if you listen to this video again about why they're telling you that. A lot of people are just going to say that because they think that's going to get your attention, and they need your attention. You understand me? However, you want to ask yourself, Zoom is a company that took advantage of a situation of COVID, of people working from home, of school kids having to be at home. You're seeing a lot of reports now that are showing that the way this particular setup was with school kids learning from home, it's not beneficial to children. So you may start seeing children full scale going back to school. I told you before is that I don't believe that many jobs are going to let you work from home. Part of your implicit contract with your employer is that they want to control your time. They want you to show up at their job. They don't want to pay you to sit at home because they want to see what you're doing. Okay. Therefore, I don't see how Zoom continues to scale this business out, and they don't have a moat, and Microsoft Teams is probably coming for their neck. And I don't see how they're going to protect themselves from that. I told people a long time ago, if I was a Zoom CEO, I would have sold this company already, because I don't believe it gets better than this. I don't. I told people, and I talked about this on my Market Mondays, Zoom is a 91 Redskins. Go look at the 91 Redskins. Even if you want to live in 91, go look at the 91 Redskins, understand what kind of year they had. Now look at every year they've had since then. Zoom is a 91 Redskins. I don't believe it gets better than it got this year for them. And I believe that this is a $200, $240 stock until they show otherwise, until they show some type of moat, until they show that they can make switching costs very expensive for their users, right? Until they show that they have an extremely long lifetime value as a result of high switching cost. I think there may be a $200, $240 stock if they're lucky. Okay, so that's that example. Now let's go into Tesla, another tech stock. Now, what are we seeing from 2/3/21? Just selling off. Some green days, but just selling off. Right? Massive sell-off day here, massive sell-off day. 66 million volume on a red day. Right? 40 million volume on a red day. 20 million volume, 30 million volume, 64 million volume today on a red day. This thing is selling off hard. Selling off real hard. And it sold off from where? Ever since it hit 900, it just started to sell off. Couldn't support the price. Now, this was a ticker at one time, hit 2,000 pre-split. But that was a different era. It's not the same era we're in right now. And we understand that a lot of money went into Tesla. Why? A lot of liquidity in the market. SoftBank over there in Japan buying hella call options, making the market makers have to hedge that by buying stock, which means that the shorts now had to cover. They had to also buy stock, which pushed this thing up. Okay. So we're seeing a lot of demand on this. However, same thing. Where's the support at for Tesla? Support's around here. So let me plot this out again. So let me draw it. Let me see, can I get it down? Support's around here. There's not any real support in this area. So if this thing continues to sell off, what stops it? Except a dead cat bounce. Or the buy the dip people try to come in and stop it. And I want you to understand something. There's a guy on YouTube, really, really good video. And he talked about the ascension of Tesla. And we talked about, and let me go to the 2-year. Around here, you had the hardcore Tesla people. Some of these people actually even owned the car. So that's one of the reasons why they believed in Tesla. And, you know, Tesla for years traded under $100. Literally for a very, very long time was an under $100 stock. Nobody really cared about Elon Musk. He was just seen as some eccentric dude talking about EV cars. Okay. Where you really saw Tesla really starting to ramp up was right after COVID. And one of the reasons is because of what happened in the economy, right? And what the Federal Reserve did in regards to monetary policy, right? And people really being a lot more confident putting their money into speculative companies because they just needed to put their money somewhere to try to get a return on it. We've seen Tesla really started to move up. Then Elon Musk came out and said, hey, we're going to split the stock. For some reason, that caused a demand on the stock. But what we saw with Tesla, their ascension was a lot of individual investors that were passionate and true believers in the company. They bought into this company for a very, very long time, but that was like under the $100 mark. Then you started seeing a lot of the smaller individualized firms or funds buying into Tesla. Okay. Then what you saw was retail. Now they bought into Tesla. Okay. So then the retail jumped on it because you got people like Kathy Wood and this other guy jumping on these television shows and telling you why Tesla should be $10,000 in 5 years. Okay. Then Tesla, because of 5 years of showing profitability, even though the only reason that they can show profitability is because they sell EV credits, they're really not a profitable company. And even with EV credits, their profitability is under 5%. But you have people that'll tell you, well, it doesn't matter because they're driving revenue. If you believe in that, I'm cool with that. If that's how you've been trained, is that a company is a good company, even though they're not profitable, but as long as they can show revenue statements, and this company's been operating for over a decade, but they've never really been profitable, but that's cool as long as they're driving revenue, then I agree with you. I'm not going to argue with you because I understand that's your training. Okay? So then they get inducted into the S&P, which means what? The big firms now come into Tesla. What does that do? It drives it up because they're being forced to buy it. What we're seeing now is some of the same individual smaller firms that really put a lot of the gas under Tesla to drive it up, especially right before the stock split. They're cashing out. What we're going to see now is that's going to force retail out. And then what we're going to also see is that once these big firms that brought this in, because they got to mirror the S&P, once they start to recalibrate their Tesla holdings, you're going to see even more selling. So you're going to see a reversal of the people that bought in from a sell-off standpoint. And the only people that are going to be left holding it is going to be the true believers, because they're going to hold Tesla even when it goes back to $200 because they believe in the company, because many of them own a Tesla, right? They weren't with it just because they were trying to make a quick return. But I was trying to explain to people, when a company does 300-400% return over a year, you got to be crazy to believe that that's going to be sustainable over the next year. Like, I don't know how you believe that. So you think Tesla does another 400% return in 2021? Like, that doesn't make a lot of sense. And I'm not one of these people that believe in like valuation formulas, but it's just, it doesn't make sense that a company can do 400%, 500%, or 300%, 200% return over one calendar year and then turn right around the next year and do the exact same thing again. Because if you look at Tesla's fundamentals, they're terrible. This is a company that does that delivers supposedly 500,000 cars a year, right? I know things about Tesla that a lot of people don't know, and I'm not going to present it to you because I know if you're bullish on Tesla, it don't matter what I present to you. But I'm short Tesla, and I'm not short Tesla by shorting the stock. I wouldn't short the stock to save my life. I am short Tesla through put contracts because I'm playing Tesla for three things, and this is not investment advice. I'm playing Tesla to go bankrupt. I have long dated puts, right? Literally as far out as you can go on the options chain because I'm playing this thing to go bankrupt. Or I'm playing Elon Musk to be taken out of Tesla, where he's going to be removed from that company for whatever reason. Or I'm playing Elon Musk to go to prison. That's the three things. And if any of those three things happen, this thing tanks very, very hard. And I just make my money off implied volatility. That's not investment advice, but that's what I'm playing Tesla for. But I want you to understand is that when you're buying the dip, right? You're buying the dip here. The question is, what's the support line? What does this thing bounce and go back to 800 or 700? And if it does, is that a dead cat bounce, or is it the fact that it's found a support and now it's moving back up? And if you don't know that, then why are you buying the dip? You understand what I'm trying to tell you? Because fundamentals was never supporting this company. It was never being supported off fundamentals. This company's worth more than Toyota and Honda combined and Ford combined. And these companies sell millions of cars every year. And I know people are going to say, well, they're more than a car company. 90% of revenue comes from car sales. You got to really understand what you're involved in. And you got to separate yourself from people like this woman who just gets on TV to talk about whatever. Guys like Ron Barron, who's going to tell you one thing, but the people that he got a fiduciary responsibility to, he's going to tell them something different. And try to figure out how can you surround yourself with people that's going to give you an accurate representation of what's actually going on, even if it's not what you want to hear. But the mentality that you should buy stock regardless of the condition of the market, I personally don't think that's wise, and I don't think that's responsible advice. You should not be addicted to buying stock, no more than you should be addicted to buying Starbucks, or you should be addicted to buying shoes, or you should be addicted to buying clothes. There should be a justification or a reason why you're purchasing something, because buying behavior is emotional and therefore you can get caught up in it. So that's going to be the end of this little presentation. Hope I wasn't too long. Hope I didn't ramble. If you want to get actually tapped into a community of people that kind of understand how to play the markets, we don't cheerlead stocks. We don't cheerlead CEOs, and we're here to make money and not be fans of companies or CEOs. Reach out to me about the highest paid part-time job on the road options trading course. Hit me up about the IPO lockup course, because we're going to make a lot of money off retail this year who are buying dips, and they're buying into speculative companies. And I can't guarantee you anything, but we already have track records of success in that particular area. Hit me up in the comments, share, like, subscribe. This is David W. Williams, also known as Diamond Dave, and I'll talk to you later.